What weak currency really means. First things first, what does it even mean when economists say a currency is weak? Currencies are always valued relative to others. If one US dollar could buy 100 Japanese yen last year, but now buys 150 yen, the yen has become weaker compared to the dollar. It doesn't mean yen suddenly lost all usefulness. Inside Japan, people still use it to buy groceries, pay rent, and earn salaries. What it does mean is that it takes more yen to buy things priced in dollars, like oil, technology, or overseas vacations. On the flip side, it means people outside Japan can buy Japanese goods more cheaply. A weak currency isn't automatically bad or good. It just shifts the balance of who wins and who loses, and that's why governments sometimes push their money down on purpose. Exports become cheaper, and boom, one of the biggest reasons countries want weaker currencies is exports. Think about it, if you're Germany selling BMWs or Japan selling Toyotas, a weaker euro or yen makes your cars cheaper for American, British, or Canadian buyers. This is exactly why Japan and China have often been accused of keeping their currencies artificially low. Their economies rely heavily on exports. If a Toyota Camry costs $25,000 in the US, and suddenly currency shifts make it $23,000 without Toyota lowering the sticker price, demand spikes. A weaker currency acts like a built-in discount for the entire nation's exports. It makes factories busier, keeps jobs safe, and strengthens the global position of national industries. Take China as a case study. For decades, it was accused by the US of deliberately undervaluing the yuan to keep Chinese goods cheap in Walmart and on Amazon. This fueled its rise as the world's manufacturing powerhouse. Tourism gets a huge boost. Exports aren't the only winners. Weaker currencies also make countries irresistible to tourists. If the euro falls, suddenly Americans find Parisian cafes and Italian hotels more affordable. If the Thai baht weakens, European tourists flood in because their money stretches further. Better hotels, more shopping, more spending. Tourism is a massive income source for many countries. In places like Thailand, Greece, and Mexico, weaker currencies have often led to tourism booms because travelers love the value for money experience. Governments know this. They sometimes let currencies slide on purpose during economic slowdowns to attract more foreign visitors, bringing in much-needed cash. Local companies gain protection from imports. Now let's flip the coin. If your currency is weak, imported goods become more expensive. That sounds bad at first, because who wants pricier iPhones or foreign cars? But here's the strategic benefit. When imports cost more, people are pushed to buy locally made goods instead. For example, if the Indian rupee weakens against the dollar, electronics imported from the US or Japan shoot up in price. Indian-made alternatives suddenly look much more attractive. This protects domestic industries, giving them space to grow and reducing reliance on foreign suppliers. It's like an invisible trade barrier. Instead of imposing tariffs or taxes, the currency itself makes foreign goods pricier and local products more competitive. Government debt feels lighter. One more factor that may not be immediately apparent is that governments might lessen their burden of debt by using weaker currencies. A country's real worth of its debt is reduced when it borrows money in its own currency because inflation, which is induced by a weaker exchange rate, lowers the value of the loan. Take this into consideration. If you borrowed $1,000 many years ago, but the value of that same amount today is significantly lower due to inflation, then the actual cost of repaying that debt can be considered to be lower. This tactic is especially appealing to governments that are now struggling under the weight of domestic debt. Through the process of allowing the currency to weaken, they can effectively repay what they owe with money that is cheaper. Obviously, this is only going to work if the majority of the debt is denominated in the local currency. When a nation borrows money in dollars or euros, a weaker local currency makes it more difficult to repay the loan rather than making it easier. Because of this, nations like Argentina and Turkey, which have a significant amount of debt owed to foreign countries, frequently experience currency crises when their currency depreciates to an excessive degree. Boosting employment and factories. every government wants to keep unemployment low because joblessness leads to unrest. Weaker currencies help by boosting exports, tourism, and domestic industries, all of which create jobs. When factories have more orders from overseas, they hire more workers. When tourists spend more locally, hotels and restaurants expand staff. A weaker currency can kickstart economic activity across the board. It's no accident that in tough economic times, central banks sometimes let their currencies slide or even cut interest rates to weaken them. More jobs mean happier citizens, and happier citizens mean more political stability. How central banks weaken currencies. What are the exact methods that nations use to devalue their currency? There is no way that they can just turn on a switch. Changes in interest rates. When interest rates are lowered, a currency's value decreases because it becomes less appealing to investors around the world. The value of money is decreased when it is printed, which is accomplished by increasing the supply of money through stimulus or quantitative easing. Intervention in the currency market occurs when central banks sell their own currency directly on foreign exchange markets, which results in a decrease in the value of the currency. For instance, Japan has been known to intervene in markets in order to prevent the yen from being excessively strong. This is because a high yen is detrimental to Japan's export economy. The risk of inflation. Of course, weakening your currency isn't free of consequences. One major risk is inflation. When a country's currency weakens, imported goods cost more. Think oil, food, electronics, things many countries rely on. If imports get too expensive, inflation rises, and people's everyday cost of living shoots up. The currency war problem. There's also a geopolitical angle. If one country weakens its currency to gain trade advantages, others may retaliate. This creates what economists call a currency war. The 1930s Great Depression saw this play out, when countries devalued their currencies to outcompete each other, leading to global instability. More recently, the US and China have accused each other of playing currency games to boost exports. Real-life examples. Let's wrap this up with some famous cases. China. For decades, China was accused of keeping the yuan undervalued to dominate global manufacturing. This fueled its rise as an economic giant. Japan. The Japanese government has repeatedly fought against a strong yen because it damages car and electronics exports. Switzerland. In 2011, Switzerland intervened heavily to stop the Swiss franc from getting too strong because it threatened the country's banking and tourism sectors. Free lunch. The hidden costs, higher inflation, more expensive imports, and political risks always lurk in the background. The truth is, no country wants its currency too weak or too strong. They want it just right, strong enough to keep people's purchasing power, but weak enough to keep the economy competitive. In the end, a weaker currency isn't a sign of failure. It's often a deliberate move in the endless chess game of global economics. Global